Good Wednesday to each and every one of you. Welcome to our Managing an Options Portfolio webcast. I'm Connie Hill. I'm sitting in today for Brent Morse, who's maybe he's out golfing, having a good time. I don't know what Brent's up to today. In any case, I'm happy to be here with you. In terms of managing your portfolio, the focus today is going to be on managing iron condors and how we approach that. And we've got several examples we're going to look at to have a good discussion here today. So appreciate you being here. We are joined in the chat by Ben Watson, fellow coach, good friend, veteran of the markets. I don't know, Ben maybe started trading when he was 10. I don't know, as a kid. I know he started as a kid. So he's a great veteran of the market. So if you have questions, go ahead, ask us. Ben is very familiar with anything we might be talking about here today. And so we do want your questions to get answered. I'll keep an eye on the chat here as well. Now, I hope you're following us on X. I'm Connie Hill CS. Ben is Ben Watson CS. We'll post educational content throughout the trading day as we might notice things and things that we think you might be interested in. So follow us. It's free. It's easy to do. Let's go through our disclosures and get down to business. Options carry a high level of risk and are not suitable for all investors. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. Of course, an in-the-money option has a higher risk of being assigned early. We will be using the Paper Money software platform here today. Looks, feels, smells like the real Thinkorswim, but using real data, but fake money, right? One thing that Paper Money does not do is doesn't assign early. A live market absolutely can and will assign early. It doesn't replicate that in Paper Money. So I like to point that out to you. Past performance is no guarantee of future results. Happy to see so many familiar names and faces here. Just a quick hello to Michelle, Sharon, Kevin, Janelle, Richard, PR, Life in the Fast Lane, Will, Jim, Posh, Carol, Final Approach, John, Will, happy to see all of you here today. For our agenda, we'll talk about, as I mentioned, we're going to focus on managing iron condors. Now, I have a couple in my portfolio. Brent has one in his portfolio, and we're going to look at all three of those here today before we put on any trades. Now, I have a question for you. How many of you trade iron condors? That's the first question. And how many of you tend to manage them as two separate trades, meaning you manage the put spread and the call spread a little bit separately from each other? I'm just curious to know what your outlook is there. Let's head over to, we're going to start first on my Thinkorswim. And we're going to start out with a little stock you might be familiar with called Apple. All right, Apple. We put a trade on, not in this class, but a different class. We put on a trade, an iron condor and Apple, because it was trading sideways. Okay, it was just kind of range bound. Okay, there are several of you that are trading them and like to manage them separately. Sharon says yes to both of that. Life in the Fast Lane says both. Some of you are not exposed to iron condor, so we're going to spend a little bit of time on that here today. An iron condor, really, you're just putting on a credit spread at a place where you don't think the stock's going to drop to or rise above. And so on this trade, we had sold the 217.50 puts, and you can see I've got a little blue line there, and we sold the 245.50 calls with the expectation that Apple would just kind of stay in this range where it has been. Okay. Kevin says, I rarely do iron condors, but when you do, you manage them individually. Okay, not uncommon at all. All right, so let me show you what happened with this trade. We're going to come over here to the monitor tab. We're going to come over to the account statement. I've got Apple in here. And when we got into this trade, it was the 27th of August, and we brought in a 91-cent credit. So not too shabby for a $2.50 wide spread. Okay, we managed it separately. I want to show you what things were looking like on the 16th of September, which was just yesterday, where we bought the put side of things back for a penny. Okay, so let's see what things were looking like on the 16th, which was yesterday. Now, it had stayed in this area, kind of between those two boundaries. This little yellow mark here, I had put in there so that we could make sure to not forget about the Apple product review that they always do in September, laying out their new products. It's usually a big announcement for the stock. Usually can move it pretty big, not as much in recent years, but say 10 years ago, man, that could make the stock just fly one direction or the other. In any case, we wanted to keep track of it. And really, the market, it got kind of a tepid review, right? No, I shouldn't say everybody. Some people were like, oh, not that big of a deal. There's nothing that blew our socks off. So the price of the stock dropped a little bit, but still started, stayed in this range. Well, by yesterday, we were at a point where it's like, you really need to make a decision here. You need to get out of this trade or do something. Many times traders will take a 4 to 10 day window before the options expire, and they try to find an exit point in there somewhere. This is true with an iron condor or many spread strategies, okay, that you're like, you don't want to be in here that long. Now, time decay usually can be an element that we need to have patience with iron condor so that the time decays, helps us lock in that profitability. Okay, so yesterday, this thing, really up here at 242.50, that cost spread was, I'm going to say it was threatened a little bit, okay? But because so much time had decayed, that's why we were able to buy it back for just a penny. And notice it was just the put side of things. So we still have the call side of things sitting there. So as we go and kind of take a look at the numbers here, we've got left on the call spread, we brought in 56 cents on it. And that's the net here on that vertical. And right now it's showing that if we wanted to close down that spread, it's going to cost us a little bit, okay? It's going to give us a little bit of a negative number here to do it. So let's talk about what's at risk now on this particular trade. It's going to cost us a little bit to go buy it back if we wanted to. But what's our max theoretical loss here? Our max theoretical loss is going to be 250 minus our credit of 56 cents. And so that brings us to basically $1.94. Do we want to have a potential of taking a max loss on this trade at $194? Or would we prefer to say, 37 is not quite such a bad trade. We made profit on the put side of things, maybe exit the entire trade, maybe not as big of a gain as we had anticipated, but at least still walking away with a gain. Okay. What's your preference? Answer that to yourself. Are you willing to risk $194 of a max loss? Because this thing, Apple could come out and say, oh, our sales are doing this, our pre-orders are doing this for all these new products that we offered. At any point in time, they could do that. Okay. So I hope you answered yourself, and I hope you said, let's minimize risk. All right. Because that, you always want to be minimizing your risk if you possibly can. All right. So that's what we're going to do. We're just going to close it out. We are going to take a little bit of a loss here on this part of the trade. But like I said, we made money on the put side of it. So overall, the net of the iron condor is going to be positive. We don't want to take a max loss. And quite honestly, we've only got 2 days left. We really shouldn't be holding on to this anymore. We really have passed that window of our 4 to 10 days. So we're kind of like out here in the fire danger zone. Yeah. So we're going to go ahead and do that. Let's go ahead. We'll create our closing order. We'll go buy it back here for, looks like about 95 cents. So we're going to do that. We're going to be on our way. We're going to be out of that trade. Okay. Now that was an approach of managing an iron condor separately. Let's look at another example here. Quite honestly, this one we have no business still being in. Okay, we've got GE here. These were some trades we did because we were seeing some sideways activity kind of in the market a little bit. Let's go look at the chart here on GE so you can take a look. And you can see it's kind of in a sideways pattern here, not making a whole lot of progress. And on it, our short put verticals down here at 260. Our call vertical is up here. Our short leg is 290. So really, it had just been doing what we expected it to do all along the way until when? Yesterday. That's how quickly you can go from a profitable trade to an unprofitable trade. Okay. Now, is there much danger of the put spread being having an issue where we take a loss on it? It's not very likely, but obviously it's not certain. The only way it becomes certain is if we close out that side of the trade. Some of you may have experienced this before where you're thinking, I am sitting, in this case, let's say the put spread, and I'm in fabulous shape. I just got to last 2 more days, and then we're home free on that side. Okay. And then something happened with news. If this has happened to you a time or 2 or 3 before, you start to be really cautious. You start to say, I don't know that I want to risk it if it's close. Okay. So some traders may decide to say, I would close back that put spread. There may be other traders that feel like it's not really likely GE Aerospace is going to get that low and threaten that side of the spread. And so they might maybe take a breath and just let it be. As we're sitting on this right now, we still have all the legs in here. So if we wanted to buy back the call spread here, if I said, or rather the put spread, if we wanted to buy back the put spread, it looks like it's going to cost us about 7 cents. So $7, not too bad. We only did 1 contract on these, okay? To buy back the call spread here, let's see which one. It's going to be this one right here. The 290, 295 call spread would cost us $1.66. Okay, you're like, oh, that kind of smarts. We could go back buy back the whole thing for $1.54 because it's just really taking into credit the fact that we'd get a little bit of money out of the 7. Well, it would take into consideration both of them, right? We've got 7 cents here. We've got $1.66 here, and then it's taking the midpoint here, okay, to close out the whole entire spread. Okay, so ask yourself, what would you want to do? What kind of position do you want to put yourself in? Now, some of you are saying, take the nickel, avoid the pickle. Thank you, Carol. Appreciate that. Ricebird said, always avoid the pickle. I love the pickle graphic in there, Ricebird. Yeah, some of us might have that idea. Like if you've gone through it before, man, you just typically want to be safe. Now, let's go examine here. What would our max loss be? Well, we don't anticipate a max loss on the put side of things, but on the call side of things, I went through and ran the numbers. We basically, the net on this call spread was about 73 cents. So our max theoretical loss on a let's see, this is a $5 wide spread, was, let me look here. You know, let's run the numbers here. I think I did the math on my own, and I was thinking it was a $2.50 wide spread, and it's a $5 wide spread. So $5 from our credit initially on our net there, that was 73 cents. That's going to be what? $4.27 is what our theoretical max loss is on that side. That's a chunk of change. Now, is it being threatened? It is. It popped up here today. It's above 290. Okay. Now, today, it gave us a little breathing room, not a whole lot. Okay. But it gave us a little breathing room today where you're like, oh, maybe it won't be so bad. Maybe we won't have to take a max loss. Okay. But you just weigh you just weigh. Do you want to take a max loss, or would you rather take a partial loss? In this trade, we probably just want to take a partial loss. Now I'm going to go on the side of being conservative and close down the trade altogether. Again, if you wanted to keep the put side open, that's kind of your approach to things, so be it, right? Then you wouldn't necessarily, you'd be getting a little bit more than we're going to, simply because we're going to go buy it back altogether. It would save $7. Okay, we're going to go along with what Ricebird says as far as avoiding the pickle. So we're going to go ahead, we're going to close it down, and we're just going to do the whole thing. All four legs here, $1.35. $1.37. Oh, let's try to get a buck. Let's go back to $1.36. See if we can get filled a little bit cheap, a little bit less expensively. Not going to be right. Let's see here. I might have to go change that back. Let's go change it to the mark price here. It's kind of bouncing around in a little bit, but we don't have time to waste. Okay, so we're going to expect to be closing on that soon. Now, Ricebird says, Ben has ingrained that motto on us about the pickle with his singing pickle. You know, I haven't seen the Ben Watson singing pickle for a while. Dang, if I could bring him on, I would. Yeah, you got to listen when Ben sings, that's for sure. Now, P. Anderson says, well, what would it look like to roll up the put vertical? And I may have answered your question on that, P.L. Anderson, by saying it was going to cost us 7 cents to go buy back the put side of things. All right, hasn't gone in yet. Okay, I'm going to make sure it does. If it doesn't do it in our session here today, I'm going to make sure to go do it. Now we get to jump over to Brent's portfolio and see what Iron Condor he has going on here. And guess what? It's in the same boat. It expires on Friday. And it is T. AT&T. Now I took the opportunity to do on Brent's charts what I do with my charts. And that is to put where our short leg is. So the short leg on this Iron Condor is at 27, and I think it might just be a $1 wide spread. The price of the stock is pretty low here. And then 30 is the call side of the spread. Now, up to this point, it really hasn't been threatened. It hasn't gone above 30 at all in this period of time. So it's sitting in a much better situation. So let's go look at the numbers on T. So on AT&T, let's see here, it looks like we got 15 cents on the put side of things, and we got 10 cents on the call side of things. Okay, so what is that going to net to? About what, 25 cents ish? Okay, if we wanted to close out the entire spread and avoid the pickle, that actually, let's try this again. Let me see if it'll, it is acting a little differently than mine. So what we're going to do is we're going to just hold down the shift key and get all of the strike prices, create the closing order, and it's still just showing us the one put. Why is this being a little bit funky on us? Let's see. I really want to close down the whole thing. And we're seeing here on the mark price, we've got less than a penny, 6 cents, and then less than a penny, and less than a penny, and 2 pennies. Okay, so it should be really small that we can do that. Now, some of you are going to take the gambler mentality and say, well, leave the put spread alone. No way AT&T is going to drop down that low to 27. And some of you might say, be more cautious on the call side of things, because that's the one that is closer to right now. Okay. Clearly, if you wanted to, you could just let it expire worthless. Let's see how many contracts we're talking here. 5 contracts. So the max gain for the whole series, not including commissions, would be in the neighborhood of about $125. Okay. So to buy it back, yeah, you're going to reduce from that $125 a little bit, but then you lock in that gain. Now I want to close the whole spread out, and I'm not really sure why it's not letting me There we go. I had to hold my shift key down even longer. Brent's set up a little bit different than mine. Okay, so we can buy it back for 8 cents, which is what we're going to do. Okay, let's avoid the pickle. We'll buy it back. We'll lock in a partial gain for that trade, and we'll be on our way. Okay, so sometimes with these iron condors, you may manage them separately, kind of like what we looked at with that Apple trade where we did manage it separately. Sometimes if neither side gets really threatened and it just hangs out there in the middle like you love it to do, then you can just buy it back, or you can take your chances if you want. That's always a risk that some people, they're like, oh, I don't want to pay the commission on it. Have you ever thought that to yourself? I know in my younger days, I used to think that, oh, I don't want to pay the commission. And then, if you get hurt a time or two, you're like, that commission isn't so bad. In fact, commissions aren't so bad these days as they were back in the olden days when Ben and I started trading, and you had a fixed amount for whatever your trade was, in addition to paying for each contract. So it was a bigger deal then, maybe not quite as big of a deal now. Okay, any questions on those iron condors? All right, if you have them and I didn't catch it, go ahead, chat it into me again. I am kind of trying to keep an eye on the chat, and not even a kind of. Okay, back to Jayton's question here. What does the column trend and the whole C represent? Okay, you're talking about my charts, and they were the charts that I had on my paper trading account on the charts. And these go back to a script that James Boyd, if you go to James Boyd class, you're going to see this. I'm going to say almost every class, not all of them, but almost every class. He uses a lot the 10 and the 20-day whole moving averages for technical analysis, and he's built a whole little system around that idea. And so that's what those moving averages are. I think you may have been referencing here the trend that has 3 here, and then the whole C. Let's see what that whole thing says. Whole C count. How many days has it been above the 10-day moving average? Okay, so Apple's been above it for 2 days, and GE's been above it for 6 days. These are not scripts that I have sitting here to share with you, but if you go to James Boyd's X account, he's got all those scripts posted right at the top of it. And look for, this is Trend Weekly, and then I have it underscored JB so I know who it came from, which was James Boyd, right? And then the whole C count 10-day or 10 moving average. How many days has it been above the 10-day moving average? And sometimes we'll use that as part of our analysis. Not so much here today. All right, see if there's any other questions here I missed, but I think we might be in good shape. All right. Barat says, can you share the 5 times 20 moving average color chart? Barat, is this something from from my class when we did 520 crossovers earlier this week? Is that what you're looking for? If it is, sure, I can share the chart with you, and it's really easy to create. Let me see, I might even have it sitting right here. I have it right here. 520 crossover, also showing the arrow. If those of you that weren't in that class, you're going to go, I don't know about that. But I will share it with you. Remember, as we share scripts, they're never guaranteed as to accuracy or timing. Okay, so I'll share that chart. And let me just show you real quickly. Really, all I'm sharing is the setting up the moving average crossover, 520. Here's the moving average, here's the 5, here's the 20. And then this one where it says moving average crossover, I put in the 5 and the 20, and then it gives you an arrow on the up. When it moves up, when the 5 moves above the 20, then it also gives you this green arrow you can look for, okay? And so it's not hard to construct at all. Let me go back to that share, get the URL. Those of you that are here in person, I'm going to put it in the chat. Those of you that are looking at this on the recording, I just posted it right there, but I think it's also in my notes. from that particular class, Barat. Okay. Kevin says, I would say every class for JB script at least 10 times. Sometimes it feels like that, right? You have to kind of keep track. All right, let's move on. What is one of the lessons maybe we can take away from the iron condors that we looked at today? GE had a problem. Apple had a problem. AT&T not so much. AT&T stayed there. What's the problem that you might see with these two iron condors that make you say, I don't think I want to do an iron condor? Okay. You can answer me that in the chat. You can answer that yourself. You can tell the dog, your cat, whatever you have around your computer screen. What might be the problem that might say, maybe right now is not the time for iron condors? Now, the market we've got mixed markets today. S&P and NASDAQ kind of pulling back a little bit here. Russell 2000 and the Dow, before our class started, both of those were fairly positive. I would say the problem here is the fact that maybe the call side keeps getting threatened. The market and some of these stocks, even though they're in a sideways pattern, are moving enough to threaten or make that call side of the iron condor not that profitable. Okay. Greg says double loss. No range. They kind of broke out of that sideways range. They had been in it, and we don't ever really know. We got into these iron condors when the S&P was being fairly flat, and we were seeing a divergence on the RSI when we were looking at the indexes that were indicating potential weakness. And so that's why we went with the iron condors, because we were seeing it be neutral, but it moved just enough that you might go, I don't want to put a call side on that. And so that's the lesson we're going to take away, which is we're not going to put on the call sides. Okay, maybe we just might stick with puts. So let's head over to Brent's charts, and we're going to put these in this class so that they can be monitored. First one we're going to look at is this one, Marvell Technology. And this one's kind of interesting because it had been fairly weak, right? We see, if I drew in that diagonal trend line, it might look like, I want to connect at least a couple of days here. You know, it might look something like that. The low points keep getting a little bit lower, but what have we got down here? It found support at 61. It made a higher low here, right? This low is higher than this previous low. And then today, maybe even a little bit yesterday, but certainly today, we've got a higher high. Now, some might not feel comfortable until it gets beyond that diagonal resistance, okay? On this one, what I'm seeing really is that it's early in showing the reverse of the trend. And maybe, let's zoom in just kind of right here. Yesterday may have been what we might call a Cahold, and we're getting a little continuation here. Caholds are only on uptrends, and I would say at this point, barely yesterday, short term, it turned into a bullish trend. Okay. Barat says, I was looking for the 520 with the crossover. I believe it was on Brent's chart. Actually, it was on my chart. Okay, so hopefully that script should work for you, Barat, because that's where I copied it from. Baby Brent has a 520 style. I'll just peek real quick. I don't know all of Brent's setups. He has some crossovers. He's got a 530. He's got a 2050, a 1040. So he has a few, but not that exact one. All right, let's carry on. Marvell. This, some people might use this as an entry here today. MACD, the momentum's scaling up here quite well. Let's come over to the trade tab, see what we have to work with as far as options. It's traded over 13 million today. We love to see lots of liquidity in the volume. Usually that's going to lead to liquidity in the options. And on this particular one, we are going to use the October 10s. Why? Because as I looked at the October 17s, I wasn't seeing a strike price that I thought was ideal. Okay. Here's a 70 strike price that we could sell. It has a 41 delta, which might be maybe a little higher if somebody wants to be more aggressive, thinking the stock could stay above 70. Yeah, it's at 71 and change now. And then if we go out to the next strike price, it's a 23 delta that's 65 strikes, so they're $5 wide. And so because of that, I was like, well, let's see if there's enough open interest if we look at the weeklies here. So on the weeklies, I was looking at the 67, 65, which we can just barely see up here at the top. The 67 has 112 contracts, 65, 234. Okay, now we're talking about maybe some strike prices that give us a little bit of room and have enough liquidity in them, they'll be okay. Probably not really comfortable down here at 8 contracts, right? But I think the 67, 65 will be okay on. So let's change this to our 65. Let's see what kind of a credit that is. I'm going to go ahead and lock it. It looks like about 52 cents. So on a $2 wide spread, would be risking $1.48 to make 52. Okay. Probability of success here. Brent's got a column here, probability of expiring out of the money, about 67%. So typically we'll say above average probability. I shouldn't say above average. Higher probability starts at 60% or higher. Right now this is at 67. Got 23 days left in the trade. Okay. So we're going to pursue this. Now, one thing we typically like to do is figure out, well, is the juice worth the squeeze, right? Is this going to pay us enough that it's worthwhile? So let's just do a quick calculation here. We'll take our 52, divide it by 184 or 148, which is our max theoretical loss. It's about a 35% return. Okay, so some people would be happy with that. There might be others that aren't. Maybe it doesn't meet their rules. Maybe they're more aggressive. Maybe they're more conservative. And they might choose different strike prices. Vicki says Marvell is shooting for 80. It could be that some analysts have said that, right? That maybe they have a price target for it to go in the next few months up to 80. That very well could be. Pavis has a question here about after importing the script, do you save it under style or studies? That's up to you. I would save it under style. Style saves a little bit more than what a study saves. The study will save just exactly what those studies are and the parameters in them. Style will also incorporate things like the chart type, the candle type, the colors of the candles, the background, all of those types of things, the time frame. It'll even adopt the time frame. So on that, it's up to you how you want to save it. I have a lot more styles than I have studies set up, style sets, I should say. Okay, on this one, we need to do some risk management. How many contracts ought we to do here? I honestly don't know how much Brent will put towards a position in this class. Okay, but in one of my classes, we use 100. Well, we use 1,500 as a don't want to risk more than $1,500. So let's go with $1,500. And maybe we might actually, in this case, do half of that, 750, since we don't have we have some contracts here, but we don't necessarily want to be a big portion of those contracts. So let's say we're willing to risk 750 here. Okay, so let's clear this out. And so if we have 750 and we are willing to risk $1.48, because that's our max theoretical loss. Connie did that wrong. Let's try this one more time. 750 divided by 148. I stuck a decimal in there, so it made it enormous. Okay, so just 5 contracts. Here's what we ought to do. So let's do it. We're going to do 5 contracts. One thing that's helpful for traders to do is maybe put in an order that says, hey, if we get a chunk of the change, if we get a chunk of this 52%, let's get out early and let's buy it back. So typically, I teach short verticals on Thursdays, and we do this all the time. We put in an order that says if we get a chunk of it, we're going to treat it like getting meat off a bone, right? You're going to go for a lot of the meat, but you're not going to pick off every little speck. Okay, so you decide what is a good enough chunk. Okay, so in this case, let's go with, say, 70%. Okay, if we get 70%, only 30% is left. So if we have 30% times our credit here, that's 15 cents. We're going to say go buy it back at 15 cents. And if we get it, we will be happy campers. We're going to make that good till canceled. And then we're going to put this in the bucket here for short verticals and iron condors. All right, off it goes. Expect to get filled on that. Comment here says the spread is a little bit wide. How do you know if the spread is wide? Basically, you take the difference between the bid and the ask price, which I'll just, let's use this one, because that's the one we actually did, right? 175 and 183. So the difference here is about 8 cents. If we divide 8 cents by, we could use either one of these. I usually just use the ask price. If we divide 8 cents by $1.82, is it more than 10%? It's actually not. It's a pretty decent percent. Okay, if we take, and I'm just going to try to get our calculator back here. If we take 8 cents and divide that by $1.81, that's saying it's about a 4% spread. 4% spreads are comfortable. Okay, some people might draw the line at a 10% spread and go, that's too much, I'm not going there. And maybe between 5 and 10, maybe there's a little bit of discretion that's used. Okay, so even though maybe it appeared to you that the spread was a little bit wide, it's actually not bad. Okay, let's get into the next one here. Let's take a look at, and I've got several here. This one's kind of interesting. Delta Airlines. Airlines, cruise ships, where we're putting discretionary money seems to not be so bad right now. And so on Delta Airlines, looks like it's definitely making an uptrend. It set another new 52-week high up here last week, or whatever the third was. Yeah, that was last week. And what's it doing here? Just kind of pulled back about a little bit below the 30 moving average. And what's it giving us right here? It's trading above the high of the low day, right? Here's our low day candle. And right now it's trading. It's not guaranteed to close there for a hold. But many traders, if they get the signal during the day, and it looks like, yeah, it's a strong enough signal, it's not like within a penny or two, they might go ahead with it and say, all right, it meets my conditions. Let's go ahead and get into the trade. Let's head over to the trade tab and see what we've got here for Delta. So it has weeklies as well. It's traded about 3 million shares here today. We're going to use the October 17s on this one. And again, we're just going to do a put vertical. Let's see what strike prices we could use. Many traders like to use between a 30 to 40 delta for the leg that they sell and starting off there. So we've got a 39 delta, we've got a 28 delta. 39 kind of falls in that range. 28 is a little bit lower than that range. Okay, on this one, let's see if there's enough in the 55. I think we're going to have to go for the 57.50, but let me try the 55 and see if it's changed that much. Into my numbers, it hasn't changed a whole lot. In fact, it's about the same. Okay, so this would be selling a delta of 28. Okay, so higher probability trade, 66% probability of expiring out of the money, of course not guaranteed. And then what's our risk on this? This is a $2.50 wide spread instead of a $2 spread like the first one. So on the $2.50, let's go ahead. We're going to put in 2.5 minus 0.62. Our max theoretical loss is $1.88. And I'm just going to write $1.88 over here as our max loss. This as our max gain. Let's see if the juice is worth the squeeze here, right? You want to make sure it's a good enough return. In your rules, you might come up with an area that you're comfortable with, that you'd like that return to be, whether that's 20-something% or 30 or 40, whatever it is for you personally. So if we take 0.62, divide that by $1.88, that's going to give us about a 32% return. So for many people, they might go, I'm happy camper with that. So we're going to go ahead with the trade. How many strikes can we do? So let's take our $1,500, divide that by 188. That's our max theoretical loss. Oh, we would be so tempted to do 8 contracts, but we're going to do 7. Okay, we are always going to follow our position sizing rules. We are never going to do more contracts than we should. Okay, take our opposite order here. When we get a chunk of our 62 cents, let's go buy it back. Let's not treat it like Connie treats toothpaste. Connie likes to get every single spot out of her toothpaste container. We're not going to do that with this spread. So let's go 62 cents times. What if we go 75% here? Okay, if we get 75%, then maybe 25% is left. Let's go buy it back for 15 cents. Let's call it good, walk away, be happy campers. Not $15. Let's make sure we get our decimal there. I think there's a decimal there. Let's just kind of get rid of that. Make it clean, make it good till canceled. All right, we're going to send this off. We're going to put it in the bucket of short verticals, iron condors. Now, today we've managed 3 iron condors and kind of talked through their 2 different spreads, and maybe you might end up managing them separately. Something I might add on that I maybe didn't stress as much is many times you're going to start with the winning side of the trade, kind of like we had on my Apple. The put side of the spread, yeah, this is Brent's. Okay, the put side of the spread, he's got some lines here. I don't think they're quite the same as mine, but they look really similar. We ended up closing out the put side because that was the winning side, and we went and bought it back for a penny yesterday. Okay, and now we went in, and what we did is we managed our risk. It looks like he's got 100 shares of stock here. So on this one, we managed the risk and said, okay, let's minimize our risk here and our exposure. Then we put on 2 new trades. We put on 2 bull put spreads, noting that the market still is more bullish, and maybe not putting a call spread to go with them might not be the best thing in the market conditions that we're seeing right now. Okay, so then we put on those 2 put spreads. Now, I hope you're a subscriber to our Trader Talks channel. You know, it makes it so much easier for you to find our content. Okay. And so if you are a Trader Talks subscriber, do click on that little blue button, YouTube button with a blue font that says subscribe, and it allows you to see what's coming up. So coming up next is going to be Barb Armstrong with Trading Price Patterns. You're going to want to stick around for that after our break. We've got a new list here called Bite-Sized Content where we're doing some really short videos. They've got to be less than 10 minutes. And so we're doing on maybe teaching you a particular skill or a particular concept in that short bite of time. So you can see some of these have a terrific number of views. James has got 2.8 thousand views on this already. Cameron has almost a couple 100,000 views on this one. Okay, so that is why you want to be a subscriber. One thing I did want to show you if I had time, and I'm going to do it super quick, and that is where do you find the content? Okay. The content of, say, iron condors and multi-option trades, you're going to go into your education and then come under, it'll come up here to insight and education, come to options. And then iron condors specifically, since we spent most of our time there, is in the non-directional option strategies course. If you haven't gone through that, you might want to give that a look, okay? Because it'll give you some ideas about the strategy itself, maybe touch on some things we didn't touch on here in our class today. All right, let's do this. Let me just check. Ben, thanks for answering questions. These guys were pretty easy on you today. Can't believe it. We should have given Ben a much harder time. Let's see here if there's any questions I needed to get here. Lynn says, I got here late. Can you go back and rewatch later? But can you explain the chart that I shared? And SCV stands for short call vertical. And really, somebody was looking for a 520 crossover on that from a previous class that I had taught. So it wasn't really relevant to this particular class, but I went ahead and shared that because Bharat was interested in it. And just on my charts, when I diagram, I'll put in what the short legs are. So show you this, and then this is the last thing we've got to wrap up. We're out of time. Is get on the right paper money over here. So GE, so my short call vertical was up here. Okay, the call spread 290, 295, the put spread I marked out down here. So it's just an indicator. So you're monitoring your trades, makes it easy for you to be able to just kind of see what's going on. All right, you guys, appreciate your participation here today. If you're unfamiliar with either of these strategies, short verticals, start there. If you're comfortable with short verticals, then maybe experiment a little bit with iron condors in your paper money accounts. That's where you want to do your learning. All right, going to take a quick break here. Barb Armstrong's going to be next with trading price patterns, and I'll see you guys tomorrow. Well, I won't see you tomorrow. I'll see you soon. Bye-bye.